Welcome back to our final of the Shamrock FCF Educational Series for 2024. Today we focus on the letter M. Tune in next year for ROCK as we finish out Shamrock. But today we'll be focusing on the letter M, or margin account. The term margin account refers to a brokerage account in which a trader's broker-dealer lends them cash to purchase stocks or other financial products. The margin account and the securities held within are used as collateral for a loan. It comes with a periodic interest rate that the investor must pay to keep it active. Borrowing money from a broker-dealer through a margin account allows the investor to increase the purchasing and trading power. Investing with margin accounts means using leverage, which increases the chance of magnifying an investor's profits as well as losses. If an investor purchases securities with margin funds and those securities appreciate in value beyond the interest rate charged on the funds, the investor will earn a better total return than if they'd only purchased securities with their own cash. This is the advantage of using margin funds. On the downside, the brokerage firm charges interest on the margin fund, so for as long as the loan is outstanding, increasing the investor's cost of buying the securities. If the securities decline in value, the investor will be underwater and will have to pay interest to the broker on top of that. If a margin account equity drops below the maintenance margin level, the brokerage firm will make a margin call to the investor. Within a specified number of days, typically within 3 days, although in some situations it may be less, the investor must deposit more cash or sell some stock to offset all or a portion of the difference between the securities price and the maintenance margin. A brokerage firm has the right to ask a customer to increase the amount of capital that they have in a margin account, sell the investor's securities if the broker feels their own funds are at risk, or sue the investor if they do not fulfill a margin call or if they are carrying a negative balance in their account. The investor has the potential to lose more money than the funds deposited into the account. For these reasons, a margin account is only suitable for a sophisticated investor with a thorough understanding of the additional investment risk and requirements of trading with margin. A margin account may not be used for buying stocks on margin in an individual retirement account, a trust, or other fiduciary accounts. In addition, a margin account cannot be used with stock trading accounts less than $2,000. Margin trading is extremely risky due to the magnified losses that can occur. Though margin trading is regulated with a significant amount of rules in place, it should still only be done by experienced traders who understand the ins and the outs, requirements, regulatory aspects, and the potential for higher losses. We are so glad that you joined us on our 4-week FCF educational series for 2024, and we look forward to seeing you in 2025 as we rock out the end of our Shamrock series.